Mark your calendar right now. Friday, February 27th, 2026. You have exactly 10 days left. 9 calendar days. 7 trading days. This is the day the silver market faces a mathematical impossibility. This is first notice day for March silver futures on COMEX. The deadline that separates paper speculators from physical demanders. The point of no return. The COMEX vaults are running on fumes. Less than 90 million ounces of registered silver remain, and that number is shrinking by 785,000 ounces every single day. But the demand for delivery is historic. March open interest stands at 292.9 million ounces. That's 58,584 contracts. Do the math. 292.9 million paper ounces claiming delivery rights. 90 million registered ounces available. That's 3.3 paper claims for every 1 physical ounce. They have sold the same ounce of silver to 3 different people. And on February 27th, all 3 are going to show up to claim it. If you think the price drop to $75 means the bull market is over, you are falling for the trap. They crashed the price 38% in the last 3 weeks, from $121 to $75, for one reason only: to scare you into selling your contract before first notice day. Because if too many people stand for delivery on February 27th, the COMEX cannot fulfill its obligations. The vaults are empty. The math is impossible. This isn't a trading opportunity. This is a run on the bank in slow motion. And by the end of this broadcast, I will show you the exact inventory numbers, the delivery math, and the exchange rules that prove a default is not just possible. It's mathematically inevitable if delivery demand continues at current rates. I'm going to show you why February 27th is the put up or shut up moment for the entire paper silver market. I'm going to show you the registered inventory data, below 90 million ounces and falling 785,000 ounces per day. I'm going to show you the unprecedented delivery rates. February 2026 hit 98% physical delivery, meaning nearly everyone demanded metal instead of cash. I'm going to show you JP Morgan's fingerprints, issuing 633 contracts during the crash while simultaneously stopping for 137 contracts. I'm going to show you the engineered shakeout, how margin hikes, timing coordination, and bank short covering created the $121 to $75 crash specifically to reduce delivery pressure. And I'm going to show you COMEX Rule 701. The force majeure provision that allows the exchange to declare it cannot complete delivery and force cash settlement at a price they determine, not the market. But first, I need to know who is safe when the music stops on February 27th. Do you hold physical metal in your hand, or do you hold paper contracts in a bank? Pause this video right now. Go to the comments and type physical or paper. I want to see who actually owns their wealth. Comment now, because what I'm about to show you is not speculation. It's forensic mathematics, and the countdown clock is ticking. Let me explain exactly what happens on Friday, February 27th, 2026. First notice day is the deadline, the point of no return, the moment when paper promises become physical obligations. Here's how it works. Before February 27th, any long contract holder can sell their position or roll it into a later month, May 2026, July 2026, whenever, without consequence. This is where most speculators live. They trade the price action. They never intend to take delivery of 5,000 ounces of actual silver. On February 27th, any long contract holder still holding a March position will receive a delivery notice from the exchange. At that point, they are legally obligated to accept physical delivery of 5,000 ounces of silver per contract and fund the full cash value of the metal. At current prices around $75 per ounce, that's approximately $375,000 per contract. After February 27th, there is no turning back. You pay in full, you take the metal, or you default. This is the put up or shut up moment. The speculators leave before this date. They roll their positions. They close out. They move to the next month. But the banks, the institutions, the sovereign buyers, they stay because they want the metal. And this time, the demand is unprecedented. Let me show you the delivery patterns from January and February 2026, because they're screaming a warning that nobody in the mainstream media is paying attention to. January 2026, 49.4 million ounces delivered. That's 7 times January 2024. 7 times. February 2026. First day is approximately 19 million ounces delivered, nearly matching the entire month of February 2025 in just the first few days. Full year 2025, for 174 million ounces total, double the 203 million ounces delivered in 2024. And here's the kicker. The February 2026 delivery rate hit 98%. 98% of contract holders demanded physical metal instead of cash settlement. This is wildly unusual for a futures market designed around fractional reserve paper settlement. Normally, 90% to 99% of contracts cash settle. People trade the price. They don't want the metal. But in February 2026, 98% took delivery. That's not speculation. That's not a trade. That's a run on the vaults. And the data shows one name at the center of it all, JP Morgan. JP Morgan issued 633 February silver contracts during the January-February price crash period, meaning they delivered silver to contract holders. But simultaneously, in the opening days of 2026 delivery, JP Morgan issued 243 contracts and received 137 contracts. They're on both sides, delivering to some, taking from others, controlling the flow. Market participants allege JP Morgan opened shorts near the $120 peak and closed them around $78 during delivery. Classic manipulation playbook. Analysts observe a blue whale battle between JP Morgan, Citibank, and Deutsche Bank, with metal actively draining from Deutsche Bank's vaults into JP Morgan's hands. The pattern is clear. Institutional and sovereign buyers are front-running March delivery by pulling metal out during the minor months of January and February. They're not waiting for March. They're worried about getting metal at all. As one analyst noted, people are front-running March because they're worried about getting metal later. Minor months turning major signals real fear in the system. So here's the question. If January and February saw this kind of physical demand, 49.4 million ounces in January, 19 million in the first days of February, 98% delivery rates. What happens in March? March is historically the biggest silver delivery month of the year, one of 5 major delivery months. The heavyweight, and the vaults have never been emptier. Let me show you the numbers. The official COMEX depository statistics. Not estimates, not projections. Facts. February 11th, 2026. COMEX registered silver fell to 98,138,005 ounces, below the 100 million ounce threshold for the first time in history. Single-day drawdown on February 11th, negative 3,256,882 ounces from registered, plus an additional 4.7 million ounces withdrawn from eligible. That's 7.95 million ounces gone in one day. As of approximately February 15th, market reports estimate registered inventory at approximately 90 million ounces. Decline since October 2025, negative 38%, from 167.7 million ounces to approximately 90 million ounces. Average daily drain rate, 785,000 ounces per day. Projected registered inventory by February 27th, approximately 83 million ounces if the current drain rate continues. Now let me show you what's claiming delivery rights against that 83 to 90 million ounces. March 2026 open interest, 58,584 contracts. That equals 292,920,000 ounces of paper silver. Current paper to physical ratio, 3.3 to 1. For every 1 ounce of registered silver, there are 3.3 ounces of paper claims just in the March contract alone. At peak open interest earlier this month, the ratio was over 4 to 1 when March OI stood at 429 million ounces against approximately 103 million registered. When you factor in all open interest across all months, not just March, the ratio is far worse. Data shows registered coverage at just 13.9% of all open interest. That means there are roughly 7 paper ounces for every 1 physical ounce in the deliverable category. Some market participants cite an even more extreme figure, approximately 400 paper contracts existing for every ounce of physical silver when including all derivatives, OTC swaps, and bank leverage. Let me put this in perspective. Registered silver is the only metal earmarked and available for immediate delivery against futures contracts. Eligible silver sits in the vaults, 283.54 million ounces as of February 14th, but the owners have not designated it for delivery. And at these suppressed prices of $75, they have no incentive to convert. Would you sell your silver at $75 if you bought it at $30? If you're sitting on 300% gains and you think the system might break? No, you hold. You wait. So the eligible silver is effectively locked, unavailable, which leaves 90 million ounces of registered silver to satisfy 292.9 million ounces of March paper claims. They have sold the same ounce of silver to 3 different people, and on February 27th, all 3 are going to show up to claim it. What happens then? Let me show you why the price crashed from $121 to $75 in the 3 weeks leading up to first notice day. Late January 2026, silver hit approximately $121 per ounce, an all-time high, a parabolic surge driven by physical demand, Chinese buying, and speculative flows. Current price, February 18th, trading in the $72 to $77 range, a correction of approximately 38% from the peak. 52-week range, $29.62 to $121.79. Now, ask yourself, why would silver crash 38% when the vaults are being drained at 785,000 ounces per day? When February delivery rates hit 98%? When institutional buyers are front-running March delivery? Because the crash was engineered. Let me show you the evidence. Evidence 1. Margin hike weaponization. CME Group raised silver margin requirements twice within 4 days in January, from 11% to 15% to 16.5%. This triggered forced liquidation of hundreds of leveraged long positions. If you were trading on margin and couldn't meet the new requirements, you were automatically sold out. No choice. Liquidated. Evidence 2. Timing coordination. The worst of the crash occurred during thin trading hours when China was closed for Lunar New Year and LME liquidity was minimal. These are the exact conditions where a small number of large sellers can move the price maximally. Thin markets. Low volume. Maximum impact. Evidence 3. Bank short position rescue. Large banks, including JP Morgan, UBS, and Deutsche Bank, held hundreds of billions of dollars worth of short positions that were crushing their balance sheets at $120 silver. Many market participants believe the crash was engineered to let these banks close shorts at favorable prices before first notice day, force them to deliver metal they didn't have. Evidence 4. Physical market divergence. While COMEX paper price crashed 38%, Shanghai physical silver maintained a approximately $10 per ounce premium over Western spot, a screaming indicator that the paper price is disconnected from physical reality. Evidence 5. Miner behavior. Silver mining stocks only pulled back 20% to 25% versus the 38% plus futures crash. This is a classic signature of paper manipulation rather than genuine demand destruction. If demand was truly collapsing, the miners would crash harder than the metal. But they didn't, because the fundamentals didn't change, only the paper price. Veteran analyst Alastair MacLeod characterized it perfectly. The crash was an engineered flush designed to shake out week-long positions and allow bullion banks to close underwater short positions at massive discounts. Market expert Manu Rishi Gupta put it bluntly: retail investors can't slam prices like this. Over the last 10 years, big banks paid $1.3 billion in fines for spoofing silver. The message is clear. Smash the price trigger margin calls, force retail out of long positions, reduce the number of contracts standing for delivery on February 27th by time for the vaults. Every contract that gets liquidated or rolled to May is one less demand for physical metal the COMEX can't deliver. This is the trap. They need you scared. They need you to sell. They need you to believe the bull market is over. Because if you stand for delivery on February 27th, they don't have the metal. Now let me show you what happens if too many people call their bluff. Let me show you the delivery math on February 27th, based on current numbers, which change daily as the vaults continue draining. Projected registered inventory by February 27th, approximately 83 million ounces. March open interest, 292.9 million ounces. Now let's run the scenarios. Scenario 1. 25% stand for delivery, 73.2 million ounces required. That's 88% of available inventory. Barely survivable. The system holds, but just barely. Scenario 2. 30% stand for delivery, 87.9 million ounces required. This exceeds registered inventory. Default. Scenario 3. 50% stand for delivery. 146.5 million ounces required. That's 1.8 times registered inventory. Outright impossible. System collapse. Scenario 4. 100% stand for delivery, 292.9 million ounces required. That's 3.5 times registered. Complete system breakdown. Given that February 2026 saw a 98% delivery rate and January saw 49.4 million ounces delivered, a 7 times increase year over year, the probability of a historically high delivery demand in March is extremely elevated. As one analysis noted, all it would take is for 20% of March contracts to stand for delivery and the COMEX is drained. 20%, not 50%, not 100%, 20%. And we just saw 98% in February. So what happens if delivery requests exceed available registered inventory? The COMEX has legal provisions. They're written into the exchange rulebook, and they allow the exchange to refuse physical delivery. COMEX Rule 701, Force Majeure. This rule allows the exchange to declare that delivery cannot be completed due to extraordinary circumstances. The governing board can enforce monetary, cash, payouts at a price it deems reasonable rather than delivering the actual metal. COMEX Rule 580. Emergency measures. This grants the exchange authority to take emergency actions including modifying contract terms, imposing position limits, or ordering liquidation of positions when market integrity is at risk. If triggered, here's the process. 1. Declaration. COMEX announces it cannot fulfill physical delivery obligations. 2. Contract modification. Outstanding futures contracts will be settled in cash rather than physical metal. 3. Price determination. A committee of exchange officials and clearing members determines the settlement price, not the open market. 4. Payout. LOMs receive cash at the committee-determined price, not physical silver. Critical implication. The exchange sets the price, not supply and demand. This is the definition of a default. A contract that promises physical metal pays you paper currency instead. This is not theoretical. In March 2022, the London Metal Exchange canceled $3.9 billion in nickel trades and halted trading for over a week when a short squeeze threatened the solvency of major participants. The LME retroactively voided completed trades to protect banks, proving that exchanges will break their own rules to preserve the system. A COMEX force majeure on silver would destroy confidence in all COMEX precious metals contracts, gold, platinum, palladium. Decouple paper price from physical price permanently. Shanghai and physical premiums would explode higher. Trigger a rush into physical metal, ETFs with allocated storage like PSLV and mining equities. Validate the thesis that the paper pricing mechanism has been a fiction maintained by fractional reserve leverage. As one analyst concluded, in the face of an odds-on default, I fully expect the COMEX to cash settle March futures contracts for those standing for delivery as it has no other choice. And when you read the fine print, it is perfectly within its rights to do so, no matter how nefarious we all know this is. So let me ask you a question. If the COMEX cannot deliver the silver on February 27th, do you think they will let the price explode, or will they change the rules to force a cash settlement? Type explode or rigged in the comments right now, because the countdown clock is ticking, and we're about to find out if the paper market can survive. Let me show you the forensic summary dashboard. The numbers that matter as of February 18th, 2026, 3 p.m. Eastern Time. Days to first notice day, 9 calendar days, 7 trading days. Critical. COMEX registered silver, approximately 90 million ounces, falling 785,000 ounces per day. Below 100 million threshold. March open interest, 292.9 million ounces. 58,584 contracts. 3.3 times registered. Registered coverage ratio, 13.9% of all open interest. Historic low, Delivery rate February 2026, 98% standing for physical. Unprecedented. January 2026 deliveries, 49.4 million ounces, 7 times January 2024. Demand surge. Price correction from peak. Negative 38%, $121 to $72 to $77. Engineered shakeout. Shanghai premium, approximately $10 per ounce over COMEX. Market disconnect. Margin hikes in January. 11% to 15% to 16.5% twice in 4 days. Forced liquidation. Annual silver deficit. 6th consecutive year. Structural. The math doesn't work. There are approximately 293 million paper ounces claiming delivery rights against approximately 90 million registered ounces. And that registered number is shrinking by nearly 800,000 ounces every single day. February 27th, 2026 is 9 days away. The countdown clock is ticking. Either the COMEX finds a way to deliver metal it doesn't have, or the world discovers that the price of silver was never real. The vaults are empty. The drain is accelerating. The February delivery rate was 98%. JP Morgan is in the middle of everything. The banks engineered a 38% price crash to shake you out before first notice day. And in 9 days, we find out if the paper market survives. So here's my final question. The clock is ticking. February 27th is coming. If silver disappears from the open market in 10 days because COMEX can't deliver, what is the fair value of an ounce? $100? $200? $300? Leave your price prediction below, because this isn't about technical analysis. This isn't about support and resistance. This isn't about moving averages. This is about mathematics. This is about vaults that are empty and contracts that can't be honored. The countdown has begun. 10 days left. The numbers don't lie. The vaults don't lie. The clock doesn't lie. Subscribe to this channel if you want daily updates as we count down to February 27th. Every day, I'm going to track the registered inventory. Every day, I'm going to track the drain rate. Every day, I'm going to track the open interest. Because this is history in the making. This is the moment when the paper market either delivers or defaults. The countdown has started. The vaults are empty. First notice day is 10 days away. This is John A.G. Liff. We don't trade the price. We trade the calendar. Now you know.